Divorce is one of the most financially complex events a person can face. The decisions made during this process can shape the next chapter of a life for decades. Welcome to Advisor in Your Corner, the podcast for individuals navigating the financial realities of divorce in California, and for the attorneys, mediators, therapists, and coaches who support them. Your host is Alex Weinberger, a certified financial planner professional and certified divorce financial analyst. Through his firm, Marriage Financial Solutions, Alex consults directly with clients on the financial side of divorce, and the firm welcomes engagements from listeners and from the professionals who serve them, bringing clarity to the questions that matter the most to you without the jargon. This is Advisor in Your Corner.
There's a sentence I hear again and again in divorces that involve a business, and it almost always lands the same way. Some version of, the business isn't really worth much. It's just me. Without me, there's nothing there. Maybe your spouse says it. Maybe their attorney says it more politely. And if you weren't the one running that business day to day, it can be hard to argue with because you're not sure how it works either. So a little voice says, maybe that's true. Here's what I'd want you to sit with before you believe it. A business that paid for the house, the schools, the vacations, and the life you built for the last 15 years rarely turns worthless the month a divorce begins. The claim might be sincere, it might be strategic. Telling those two apart is one of the most consequential financial questions in your entire divorce, and it's absolutely one you can get right. So today, I want to give you a clear way to think about it. Why the "it's worthless" line is so common, and what's usually going on underneath it. How a business actually gets valued, in plain language. The goodwill question, which is where the biggest dollars and the biggest fights tend to live. The specific places someone who wasn't running the business gets shortchanged. And how to test the claim without having to become a forensic accountant yourself. Let's start with why that line comes up so often, because understanding it takes away a lot of its power. Sometimes it's genuinely true. If a business is nothing more than one person's labor, with no employees, no contracts, no systems, and no brand that means anything without them, and the income stops the day that person stops working, then there may not be much there beyond a job. That's a real category, and an honest valuation will say so. But many businesses that look like one person are not. The same company can have repeat clients who come back regardless of who answers the phone. A team that delivers the work, systems and processes that run without the owner in the room, a recognizable name, signed contracts, and money that's been building up inside the business for years. All of that has value, and none of it disappears just because the owner says so. And here's the part I'll name plainly, without accusing anyone of anything. The person who runs the business has a financial incentive to describe it as worth as little as possible, because a lower value means a smaller number to buy out or offset. That doesn't make them dishonest. It just means their estimate is not neutral. And you shouldn't treat it as if it were. The good news is that the value of a business isn't decided by whoever speaks with the most confidence. It gets decided on cash flow, contracts, and goodwill. On what the business actually is, not on what one side would like it to be. And the legal side of how all this gets characterized belongs with your attorney, who'll know how it plays out in your case. So, how does a business actually get valued? There are 3 basic lenses, and you don't need to master any of them. You just need to know they exist, so you can tell whether the work is being done properly. The first lens looks at earnings. It asks what the business is expected to make going forward and builds a value from that. This is the common approach for service businesses, the consulting firms, the practices, the companies whose value is really about the income they throw off. The second lens looks at the market. It asks what similar businesses have actually sold for and reasons from those comparisons. It works best when there's good data on real sales in the same industry. The third lens looks at what the business owns and owes. It adds up the assets and subtracts the liabilities. This one tends to fit businesses with a lot of physical value, like equipment or inventory or real estate, or situations where the income records aren't reliable enough to trust. A good valuation expert chooses among these, or weighs more than one, based on what best reflects the true economic reality of that specific business. And here's something worth understanding. Valuation is judgment, not a single button you press. That's exactly why two qualified experts can look at the same company and land on very different numbers, and why the method someone chooses can matter as much as the inputs they feed into it. When your spouse's side produces a low number, the question isn't only what did they count, it's also which lens did they use, and was it the right one? Let me make the lens idea concrete, purely as an illustration. Imagine a couple in Brentwood where one of them owns a design firm. Look at that firm only through what it owns and owes, the desks and the computers and the lease, and it can look almost small because a business like that doesn't hold much you can put your hands on. Now look at the same firm through its earnings, what it reliably brings in year after year from clients who keep coming back, and a very different, much larger picture appears. Same firm, same day, two honest lenses, two answers that aren't remotely close. Once you see that, you understand why the choice of lens isn't a technicality. If the other side values a strong service business by what it owns and owes, they've quietly chosen the lens most likely to make it look modest. And unless someone tells you to look for that, you'd never know it happened. Now to the heart of it, which is goodwill. Because in a business that funded a high net worth life, goodwill is often the single biggest piece of the value, and it's where most of the fighting happens. Goodwill is the value of a business beyond its hard assets. It's the reputation, the loyal clients, the referral sources, the brand, the repeat business, the systems that keep customers coming back. You can't touch it, but it's often the most valuable thing the business has. And the reason it becomes the battleground is that goodwill splits into two kinds, and which kind we're talking about changes everything. The first kind is the value that lives in the business itself and would survive the owner walking out the door. Think of a client base that stays, a team that keeps delivering, contracts that remain in force, a name that carries weight on its own. That value belongs to the business, and it's generally part of what gets divided. The second kind is the value that's truly inseparable from the individual, their personal reputation, their particular skill, the relationships that would leave with them and couldn't be sold to anyone else. That kind is tied to the person rather than to the company. Now, the it's worthless argument is almost always an attempt to shove as much value as possible into that second bucket, the personal one, and to empty out the first. I am the business, the argument goes, so it's all me, and none of it transfers. Sometimes that's partly fair, but very often a business that's being described as pure personal effort turns out, once you actually look at its contracts, its staff, and its systems, to have real transferable value sitting right there. Sorting out how much which is a factual question that valuation experts in the court work through case by case, and how it gets characterized legally, is your attorney's call. What I want you to take away is simpler. That split is where a great deal of money moves. So it's the last place you want to accept the other side's framing without a neutral look. One more thing on goodwill that protects you. In California, the goodwill of a business is generally measured at its value around the end of the marriage, not on the strength of what the owner promises to go do next. So an operating spouse can't shrink the number simply by pointing at all the hard work they claim they'll put in after the divorce. The value that was built during the marriage is the value on the table. Let me turn now to where people who weren't running the business actually get shortchanged, because these are specific and avoidable. The first is the simplest, taking its worthless at face value and skipping a real valuation altogether. If you accept the claim, there's nothing to divide, and the conversation is over before it started. That's exactly the outcome the claim is designed to produce. The second is accepting the operating spouse's own numbers or a valuation from an appraiser they chose and paid for, as if it were neutral. It isn't. A number produced by one side is a starting position, not a finding. The third is subtle and costs real money. Businesses often run personal expenses through the books: cars, travel, meals, phones, family members on payroll. All of that can make a business look less profitable than it truly is. A proper valuation adds those things back to show what the business actually earns. Skip that step, and a very healthy business can be made to look ordinary. The fourth is the snapshot question. Which date, which set of books, which year gets treated as representative? A business can have an off year or a suspiciously off year right when it matters most. Whether that snapshot is fair is something a good analysis tests rather than assumes. And the fifth is trading the business interest away too cheaply for something that looks equal but isn't. Giving up a share of a business in exchange for an asset that seems worth the same on paper can leave you behind once you account for what each one is really worth after tax and over time. Equal on the surface and equal in your hands are not the same thing. Let me make this concrete with a real situation, with the details changed. Names and identifying details have been changed for client privacy. Karen and David had been married for nearly 20 years, and David ran a business that had comfortably supported the whole family. Karen had never been involved in it. When the divorce started, the message that came back through David's side was familiar. The business was really just David. Without him, there wasn't much to speak of. Karen half believed it because she genuinely didn't know the inner workings, and that's the position a lot of people find themselves in. What changed things wasn't Karen suddenly learning to read a balance sheet. It was insisting on a full picture and a neutral expert who could look at what the business actually was: the recurring contracts, the staff who did much of the work, the name that clients trusted. The point of Karen's story isn't a dramatic number. It's that the claim she was handed at the start turned out to be a position, not a fact. And the only way she found that out was by refusing to take it at face value. So, how do you test a claim like this without becoming an expert yourself? You don't have to run the analysis, you have to make sure it happens, and that it happens neutrally. The foundation is a complete financial picture. In a divorce involving a business, the full books, the tax returns, the contracts, the records, all need to come out into the open. And making sure they do is exactly the kind of thing your attorney drives. You don't have to audit them. You have to insist the process include them. From there, the single most valuable move for most people in your position is a neutral valuation expert, often a forensic accountant, whose job is to value the business fairly rather than to argue for one side. For a lot of people who weren't running the business, that's the turning point in the entire case. The moment that its worthless story meets someone whose whole profession is figuring out what's really there. And here are the questions I'd want you carrying into those conversations. Is a qualified, neutral expert valuing this business? Or are we relying on the other side's number? Which valuation approach are they using, and does it fit this kind of business? Have personal expenses been added back to show what the business really earns? How is goodwill being handled, and how much is being called personal versus part of the business? And is the date and the set of records being used actually representative, or a convenient low point? You don't need to know the answers going in. You need to make sure someone competent and neutral is being asked. Let me speak directly to the worry that sits underneath all of this. If you weren't the one running the business, it's easy to feel like you're on the back foot. Like the other side simply knows more than you ever will, and you'll never close the gap. You don't need to close it. You're not being asked to understand the business better than the person who ran it. You're being asked to make sure the right expert does. And that is a completely different and far more achievable job. The person who built the company holds the knowledge. You hold the ability to insist that knowledge gets examined by someone neutral. On a decision this size, that's not a small thing to hold. It's the whole game. And then there's the part that comes after all of this is settled. Once the business has been fairly valued and you've received your share, whether that's a stake, a buyout, or other assets traded in its place, at some point the dividing is done and you're the one deciding what to do with what you have. That's the moment a lot of people realize they want a team of their own. Independent, fee-only fiduciary guidance whose single job is to serve your interests going forward. Naming that moment isn't a pitch. It's just where this road leads. And I'd rather you see it coming. So let me leave you with the one idea I most want to stay with you. It's just me. It's worthless as a claim, not a finding. A business that paid for your life for years almost never evaporates the month the marriage ends. You don't have to prove the number yourself, and you don't have to understand every line of a valuation report. You have to do one thing, which is refuse to accept the claim at face value and insist on a full financial picture and a neutral expert to test it. That isn't distrust, and it isn't being difficult. It's diligence. And on a decision this size, diligence is exactly what the moment asks of you.
Thank you for listening to Advisor in Your Corner. If today's conversation raised questions about your own situation or a client's, Alex Weinberger and the team at Marriage Financial Solutions are available to help. They work directly with individuals navigating divorce and alongside the attorneys, mediators, therapists, and coaches who support them. Every engagement is handled with the discretion, rigor, and independence the moment calls for. To learn more or get in touch, visit marriagefinancial.com. If this podcast has been useful to you, please share it with someone who could benefit and subscribe wherever you listen. This has been Advisor in Your Corner. We'll see you next episode.
The information and opinions presented in this podcast, including the views of guests not affiliated with Marriage Financial Solutions, is for general informational and educational purposes only and should not be considered personalized financial, tax, or legal advice. Marriage Financial Solutions does not provide advice regarding securities or the advisability of investing in securities. Marriage Financial Solutions is affiliated with Weinberger Asset Management, an SEC-registered investment advisor, and may refer listeners to Weinberger Asset Management when investment advisory services are appropriate. However, individuals are not obligated to use the services of Weinberger Asset Management